Hello and welcome. This is Advanced Income Statement Analysis Crash course. In this course, we will slice and dice this income statement and convert this into extremely useful visualizations and charts. We'll focus on variances versus budget and previous period, and with a special focus to gross profit and gross margin, which is the gross profit percentage, as well as EBITDA and EBITDA percentage. If you are someone who is involved in analyzing income statement or presenting financial statements, you know how important it is to understand each line item of the income statement, but specifically the gross profit margin and EBITDA margin. What are the causes of variances? What led to the variances? How to explain them and then present them to senior management. What I want you to do now is click on the three dots below the video and click on save to watch the video later or save it to your playlist, because you might need to come back to this video again and again. Also, if I am too fast or too slow, you can click on this settings icon and then change the playback speed to faster or slower than the original version. So if you're ready to learn advanced income statement analysis, grab your coffee, tea, juice, water, make sure there are no distractions, and start focusing now. So since we'll be talking a lot about EBITDA, it's a good idea to just quickly go over what is EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. Now, what are earnings? Earnings are net income, which means revenue less expenses. Let's take a look at our example income statement. Net income, which is really the final earnings of this business, right? So this 3 million reflects the difference of all the revenues and expenses, and this is the net profit that the company made. So you start with the net income. Now, included in this number is interest expense or income and income tax expenses. These have already been included or considered when you arrive at the net income. So if you have an interest expense, that would be deducted from your profit to arrive at the net income. If you have interest income, that would be added to your profit. Similarly, if you have income tax expense, that is already deducted from your revenues or income. Then you arrive at the net income. Now for EBITDA, which is earnings before interest, tax, depreciation, and amortization, we exclude interest and income tax, or in other words, we say we add them back to our net income, and we also exclude depreciation. And depreciation could be in multiple places within this income statement. So it could be part of the cost of sales here. It could be included in the selling and advertising and general and admin expenses. So we add them all up, and then we take the sum of the total depreciation and add it back to our income. So you see our net income was 3 million for the year 2021, but we added back interest and tax expenses, 547. In this case, in our income statement example, there will be no interest expense, so there's only income tax expense, and you can see it's $547,413. And then the depreciation amount is $1.3 million roughly. So we arrive at finally our EBITDA. Interest, tax, depreciation, and amortization are excluded. But why are they excluded? Well, this is because none of them truly reflects the operational performance. For example, interest depends on the borrowing and lending structure, not the operational performance. It does not have much to do with the business itself, but what are the funding needs of the organization. Similarly, tax depends on company's profits, but also the applicable tax regulations. So a similar company in two completely different regions or countries may have different tax expenses. So it does not really reflect the operational performance or business performance. Depreciation and amortization are non-cash expenses and really reflect allocation of capital or intangible expenditure that has already incurred. Often these expenses are incurred in the past. So you may have an asset that was purchased 10 years ago and you're still allocating the cost of that asset in the income statement. That's why depreciation and amortization are also excluded. So EBITDA is a metric that measures a company's operational performance, excluding non-operating expenses such as interest, tax, depreciation, and amortization. EBITDA can be used to compare operational performance, but has its limitations, which we will discuss in a separate section. The next question is, who uses EBITDA? Well, EBITDA is particularly important in industries with high levels of debts or that require significant capital expenditures. For example, manufacturing, energy, and telecommunication. The high levels of debt and depreciation expense make it difficult to compare profitability across different companies within these industries. And using a metric such as net income does not help because it includes expenses such as depreciation, amortization, interest, and taxes. But frankly, EBITDA is used by a wide range of stakeholders and across the board. For example, investors, lenders, analysts, and management. They all use EBITDA. Investors use it to make investment decisions, lenders for lending decisions, analysts and management to understand and compare the profitability of the business and setting targets for future years. From my personal experience in the corporate world, almost every organization that I've worked with uses EBITDA as a management reporting tool. And really, the key KPI that is discussed during management meetings and is set as target for future years, and even for bonus or compensation calculations. If you go to a finance website like Yahoo Finance and just type the ticker symbol of any famous company, let's take Apple for example, and you click on it and it brings up this information for you. And if you click on financials, you'll see the first financial here is income statement. Scroll all the way to the bottom. What do you find here? EBITDA. This is available for almost all the companies that are listed on the stock exchange. So it is quite a frequently used common KPI for income statement performance. The problem, however, is it's not easy to answer all the questions, especially when it gets into price volume mix and the percentage changes, the EBITDA percentage change, which is the next topic we discuss about what is an EBITDA percent. Let's also take a look at EBITDA percent, also known as EBITDA margin. EBITDA percent is a financial metric or a calculation which just shows EBITDA as a percentage of its total revenue. So the calculation or formula is EBITDA divided by total revenue times 100. It's reflected in percentage terms. Total revenue is often indicated by gross sales less any sales deductions. EBITDA percent or EBITDA margin is used to compare a company's profitability over periods and among its competitors. It's similar to gross margin or gross profit percent, except that in gross margin you have gross profit divided by total revenue. In case of EBITDA percent, it's the EBITDA divided by total revenue. In the income statement, the EBITDA percentage would be reflected like this. So for our Bowl Bags Inc. example, you can see 2021 EBITDA percentage was 32.3 and it dropped to 31.8% for 2022. And compared to budget, it is also below target. Budget was set at 34.1%. So this is something we'll be looking at in detail, doing all the calculations and analyzing the performance. Here are some general EBITDA percentages for some common industries. So as you can see, technology, financial services, and telecommunications are industries where EBITDA percentages are generally higher in the 20 to 35% range. Retail and manufacturing sector, the general EBITDA percentage ranges are lower, between 5 to 20%, but of course this is very general information. It really varies by each company. So now we are ready to start creating the waterfall chart for this income statement, which basically is a bridge for EBITDA change between current year, which is the year ended 2022, versus last year, which is 2021. And we'll also create a waterfall chart for 22 versus budget 22. So we will have two waterfall chart. You probably have experience of this in your work life as well. Usually the most common comparisons we see anytime we are looking at an income statement is versus prior year, same period, and versus budget or target, right? So we'll create these two, and I'll also show you how you can use the analysis that we do to create basically a comparison or waterfall chart between current year and any other benchmark or any other base. So in this case, we are doing prior year and budget. These are our two bases, but you could also do a comparison versus a year before. So for example, you could create a waterfall chart for 2020 versus 22 or 2019 versus 22. Or you could also do a waterfall chart with another company, another branch or another entity within the same organization. The first part we will focus on, which is the most important part as well, and probably takes the most time, is from gross sales to gross margin. Okay, this first portion, this takes most of the work, and this is where most of the analysis is as well. So we'll start dealing with this now. We'll see how we create Excel files that are automated to calculate the variances for us and also automated to create the waterfall chart for us. So let's get right into it. Hope you are excited. One of the charts or diagrams that I really like when it comes to explaining any profit related variances is this one, adopted from the book of Costing from Lucy T, 1996. It gives us a very good summary of the overall variances, all of the variances that may impact the profit. And you can see it starts with the operating profit variance and then it breaks it down to total sales and cost. And within total sales, you have these variances which are called sales margin price and sales margin quantity variances. And within quantity, you have volume variance and mix variance. Now, we will often see that sometimes the quantity variance is called volume variance and the volume variance is called quantity, but the idea is the same. Okay, so basically, the sales variance are divided into sales margin quantity and sales margin price, and sales margin quantity is further subdivided into volume and mix. Okay. Now you see everywhere there is the word margin included. This is important because this is reflecting gross profit or gross margin. So costs are deducted. On the other hand, the other area is cost, total cost variance. And this is more reflective of a manufacturing operation where you have direct material, direct labor, variable overheads, and fixed overheads, right? In our example, Bold Bags Inc., we are assuming that the company just buys and sells the bags, so it's not a manufacturing organization. So we won't be dealing with direct material, direct labor. This is a topic for another section or another course, and I would need your feedback if you want me to build a course on these variances. I can definitely build that. I do have a lot of experience with that. But for now, we will focus on these margin variances and the total cost variances, which will be relatively easier. I will also show you, I did talk about margin variance here, but I will also show you how you can, with a slight tweak in calculation, create a variance analysis for sales. So without deducting any costs, just the variances related to the sales dollars. And also if you want to do an analysis of the margin, some small changes, you can also analyze margin very quickly. Okay, so what I'm talking about is let's focus on net sales. So we can create a variance analysis for these sales dollars, but we can also create a variance analysis for these gross profit. So what changed in the gross profit, right? Both of these can be easily achieved and we will do both in our calculation. So here is our sample data. This is the data we'll be working with to calculate the variances for sales, net sales, and gross profit. Okay. This information has customer number, product type, the year, month, scenario, whether it's actual, current year, prior year, or budget. The quantity sold, very important. Price per unit and cost per unit are included here, but this is not necessary. What is important is we should have gross sales, deductions, net sales, cost of goods sold. Okay, and there are some calculations which we will not be using, but the key pieces of information that we need from this data is customer number, customer name, product type, or this could also be your product number. Of course, the year is important and scenario is important. And then units sold, gross sales, net sales, and cost of goods sold. These are important information. Okay. Just to show you that this data matches our income statement, I'll do a quick pivot table. So press Control A, insert, pivot table. And I just want to show you our net sales. So I'll bring net sales into the value section and gross profit into the value section. Then of course I'll bring year into the row section. And we have one more thing, which is scenario. As I convert it into dollar currency format, you can see here our net sales for 2021 is 15 million and gross profit is around 7.6 million for 2021. If you go back to our income statement, you see this matches exactly 15 million and 7.6 million. Similarly, for 2022, you see net sales is 16.6 million and gross profit is 8.2. Matches here 16.6 and 8.2. And then budget is 17.4 million and gross profit of 8.9. We see that 17.4 and gross profit of 8.9. This is just to show that we are now dealing with this section. We are trying to explain net sales and gross profit, and it's important that our raw data matches it. Notice I've already started focusing on net sales and not gross and deductions. To start with, we'll be dealing with net sales. So we will ignore deductions for now. They are already part of the gross sales. So gross sales less deductions is net sales. We'll be working with net sales and gross profit. Okay. So this is our sample data. Let's start working with automation of the file. For that, we need to create a pivot table, and it has to have a very specific format. Okay, so we will convert this sample data into a pivot table. And as far as the setup of the pivot table is concerned, what we need is this look. So our first column would be customer number, second column would be customer name, the third column would be the product, right? So this could be your product number, or in our example, this is actually a product type. We don't have specific product numbers. There's only 4 or 5 types of products. But in your case, it could be the product number, okay? And then you have the quantities and values. So we start with prior period first. So we need the same information, the same 4 columns for prior period, current period, and budget or target. So we start with units sold. We need net sales, cost of sales, and gross profit. Okay, as you see, the same information is repeated for current period, and the same information is repeated for budget or target. Okay, so this is how it should look. Our pivot table should look like. Now let's start creating the pivot table. You probably know that a pivot table can be created by pressing Control and A key, which will select the entire data, and then clicking on Insert and Pivot Table. However, we want to automate this file so that if there is any new information added, this data is for the full year, 12 months, but you may be doing this activity every month, right? So let's say you are in the month of March and you created this file. You want this file to be able to update for the month of April without you making many changes, right? A lot of the time, this information can be downloaded from the system, and every month you can update this information. And as it gets updated, you want the pivot table and your calculations to refresh automatically, right? So for that, what I suggest is creating a pivot table with dynamic range. One way to do that is to convert the data, sample data range to a table. And you can do that by clicking on Insert and then clicking on Table. That's one way, but it does not work if you have data dumped from the system. So a better solution is using something called an offset function. And we will use this functionality to create our pivot table. That way, anytime any columns are added to the right side here, or any information is added at the bottom row, there's new information, then the pivot table would automatically reflect the changes and update based on the new numbers. Okay, so we'll work with the offset function to create a dynamic pivot table range. Okay, let's see how we do that. Okay, to create a dynamic pivot table range, what we need to do is click on the Formulas tab and click on Define Name. Here you can define a name, so let's call it Data. Make sure the scope is selected as Workbook. And where it says refers to is where you're going to enter the offset function. So you type $, and then type offset and open the parentheses. The first item you will select will be the first cell where the sample data starts. So in our case, it is A1. So click on A1, then press comma, type 0, press comma again and type 0 again, and then another comma. So you have the first cell selected and then 2 zeros separated by commas. And now you will enter a count A function for the column first, and then the count A function for the rows. So you type count A, open parentheses, select column A, close the parentheses, type another comma, count A again, and then this time select the row number 1, right? So first you selected column A, which is the first column, and now you select the row number 1, which is the first row of sample data. Now remember, in our case, the sample data starts from cell A1. If your sample data starts from a different cell, you may need to modify this formula based on that. Anyway, close the parentheses for the count A function. Also close the parentheses for the offset function and click on OK. When you click on OK, nothing really happens, but you can see where the range is defined now by clicking again on Formulas tab in Name Manager. And you will see that the range that we created called data is already there. It also shows the formula that is used. Okay, so you can see the formula in detail here. Click close. Now you need to create a pivot table that is linked to this dynamic range using offset function. So click on the plus button here to create a new sheet, and let's click on insert and pivot table, and it asks you for a table of range. Here you will enter the name of the range that we just created, which is data in this case. So enter data, select where you want this pivot table to start at. In our case, we are saying it's sheet 7, cell A1. Click on OK, and you see that now it's picking up all of the fields from the sample data tab. So your dynamic pivot table is created. Now we'll start adding the fields exactly in the way I showed you, so that we are setting up the file for variance analysis. So as discussed in the earlier video, this is the format in which we will set up the pivot table. So let's go back to our Excel file and start setting it up. So if you recall, the first field was customer number. So we bring it to the rows section. We also bring in customer name. And third item is product type, which could be product number in your case. Now we have to bring in scenarios, so prior period, current period, and budget, right? So we can select scenario and bring it to the column section. And you see currently it's showing actual and budget, because for actual we have 2 years, 21 and 2022. So obviously the next thing is year, and we'll also bring year in the column section. So now you can see you have 2021, 2022. Now let's bring in the values. So we talked about units sold. We drag units sold and bring them to the value section. We also need net sales, the costs of goods sold, and gross profit. Okay. So now all the information that we need is in there. We just need to change the formatting. So the first thing I like to do is go to the pivot table design and change the layout to tabular form. So now you see each field has its own column. Okay. Second thing we need to do is make sure all items are repeated. This is very important for the calculation, right? So again, you can click on report layout and click on repeat all items. And now you can see that all the customer numbers, customer names, all the information which is in the row section is now repeated. Okay. Next thing we do is we do not want to see any subtotals, so click on do not show subtotals. We can also drag and fix the width of the columns to show us the details clearly. The net sales, cost of goods sold, and gross profit are currency numbers, so we can also change them. So if you right click on any number in the net sales field and then click on value field settings, and then click on number format, select currency and click OK and OK again. So you see it changed net sales to currency format. Cost of goods sold and gross profit are still not converted to currency, but you see that net sales in each scenario is already changed to currency format. You see that in actual and budget too. So I'll quickly do the same for cost of goods sold and gross profit. Okay, so I just did that. Let's zoom out a little bit to see how it's looking like right now. One more thing I want to do is add a row or two above the pivot table because we will be needing them later. I'll show you. Okay, and we have the totals. We don't need these totals. So one more setting that we have to do is go to the design tab and switch off grand totals. So we want them off both for rows and columns, right? So we'll click on off for rows and columns. We don't want any totals because the calculations that we will build on the right side, they do not need the totals. In fact, they will be messed up if we have grand totals at the end of the columns, right? So make sure you turn off the grand totals when setting up the pivot table. Okay, pivot table is ready. Okay, so the first variance that we will calculate is the sales price variance. What sales price variance tells us is what is the impact of change in selling price of the products that a company sells on the profit. Okay, so that sales price impacts both the net sales or sales of a company, the sales dollars, and also the gross profit. And actually it falls all the way down to EBITDA number, right? So any price increase, usually if there are no costs associated with that increase, it's just a simple price increase. The company went out to the customers and increased the prices. That will be a direct fall through to the EBITDA or the overall profitability of the company. Compare that to volume, where the company sells, for example, more quantity. Each quantity comes with the cost as well. So the increase in sales as a result of the quantity increase does not directly fall through entirely to the profit. There is an increase in cost as well as the company sells more products. That's why price increase or price is used by the management or leadership of a company as a very important tool to maintain profitability or increase the profitability of a company, especially when the costs are rising, inflation. We saw that with COVID and the supply chain issues, that the costs increased in general for many products. And that's where the companies which increase their prices to match the cost at least in time were really able to manage their profitability. So an important lesson there to keep an eye on the price and make sure the price covers the increases in costs of the products of the company. So selling price variance is very easy to calculate. And the way we have built the file, we are calculating both variance versus prior year and budget at the same time simultaneously. This applies to all the variances, right? So to calculate the price variance versus prior year, the formula is current year price minus prior year price times actual quantity sold. And similarly for budget, it's just replace prior year with budget. And actually you will notice that throughout our calculations that when you have calculated a variance versus prior year, all you need to do to calculate the variance versus budget is just simply replace prior year numbers with budget. This is great because you can apply this again to any other reference point as well. So if you are calculating the variances not versus prior year but an even older year, or with another benchmark or another company's performance, you simply need to replace the prior year portion. The current year and actual quantity, this will remain the same in all calculations. Okay. So going back to the price variance, this is how we calculate the price variance. Now let's look at our Excel file. So the reason that we have set up this pivot table in this specific format is that we want to be able to make all the calculations on the right side. So you have a copy of this file. You can go and check each of these calculations. So I will go through the calculations quickly to explain how the variance is calculated, but I will not create the entire file with you. However, you will have an assignment to complete this exercise for yourself. Okay, so follow along with the calculations, and one by one we will calculate each variance and then convert that into a waterfall chart. Okay, so what we need are the selling prices for prior year, current year, which is called actual in this case, and then budget. Okay, so the formula for the calculation of price is very simple. I'm linking it to the pivot table, and the price is calculated by taking the net sales divided by the quantity sold. I do have an if error function in there so that if there is an error, for example, for this certain combination of customer and product, there is no price, there is no net sales or units sold, I want to see a blank, and for that I have used these two quotation marks so that if there is an error, it should just leave a blank cell, which you can see in this case, for example. Right, you see a blank here because if you look at the cell, there was no sales, $0 and 0 units sold. So I need a blank. This is important that you have a blank here. Okay, so the same way I've calculated actual and budget selling price. And then when it comes to variance, these two columns represent variance versus prior year and variance versus budget. The calculation of variance for versus prior year is your current actual price minus prior year price times the actual quantity sold, which is again linked to the pivot table. And you look at the year 2022, number of units sold for this specific combination. And this way we do this for each line, and it gives us our variance by customer and product combination. Okay, the same thing for budget. The only change is that instead of using prior year, now you are comparing with budget. The calculation is there, and then these two cells are really important at the top. This is where I am summing up all of the variances. So if you press F2, you can see that I've used a subtotal function because I prefer the subtotal function. One point that is really important is that make sure that the sum range is long enough that if there is any new data that is added towards the end, it is still being captured, right? So for me, I've used the range of up to almost 50,000 rows, right? But if your data is much larger, you may need to use even a longer range, enough so that you don't miss any variances in the future when this pivot table grows, right? So make sure that you do that for all of the sum functions. So straight away we have the price variance. So it shows us that the price variance is 1.7 million versus prior year. So there's an increase. This positive number indicates that there's a price increase. And versus budget, we actually have a gap, $470,000. Okay. Next up is cost variance. Cost variance is very similar to price variance. Remember, we are not doing an analysis of the manufacturing costs. We are assuming that the company's cost is just to buy the bags that they sell. So in this case, cost variance will be calculated very similarly to the price variance. And in the calculation, you will just replace price with cost. The only other difference is that because cost is an expense, which is opposite to sales, which is an income, here, to reflect the variance with the correct signs, you will start with prior year cost. So prior year cost minus current year cost. If you recall, for sales price variance, we had current year price first. From it was subtracted the prior year price. But in the case of cost, it will be the opposite. We will have prior year cost first, and from it will be subtracted the current year cost. But the rest is pretty much the same, and the same applies to budget. When we look at our Excel file calculation, we need cost per unit instead of price, which is calculated as, in our pivot table, the cost of goods sold divided by the number of units sold for each type of scenario, right? So you can see for the first line, for example, the prior year cost was 85, which is now increased to 96.9, which is exactly the same as budget. And in the calculation, you can see that there is a negative impact or unfavorable impact of this cost increase to the profit, 21,000 for just this first line for fancy retail with backpacks. Okay. However, for budget, there is no impact. In fact, if you look at the total, you see that there is no impact for budget, which is zero, which means that the finance team did a great job of budgeting. Budgeted costs are exactly the same as actual cost per unit by customer. However, there is an impact of $1 million from the increase of purely the cost per unit. Okay. One thing to note here is that wherever you do not have a match, where the cost is a blank using the quotation marks, there is no variance calculated. So for price and cost, we ignore a situation where we do not have a per unit price or per unit cost available. Okay. Let's do a recap. So far, we have dealt with the sales margin price variance and the total cost variance. But we've not fully dealt with the total cost variance because in this hierarchy of variances, we know that selling and advertising and general admin are usually considered fixed expenses. Maybe a little bit of variable overhead variance is involved as well. But we dealt with the cost at gross profit level. And since in this business, in our example, we are buying products directly, any change in cost is really the change in the price or the cost that the vendors charge this business. And that has been dealt with the total cost variance so far. So we will go back to the overhead or fixed expenses variances, which are the selling and advertising and general admin. But we are still on the total sales margin variances. And the next variance we will calculate is the sales margin quantity variance, which of course is further subdivided into volume and mix. I like these names. It makes sense. When we will look at the calculations, I believe you will agree with me that this makes more sense to call the total variance of the change in quantity as the quantity variance, and then further subdivide it into volume and mix variance. So let's start with the main variance, that is the sales quantity variance. Sales quantity variance is calculated as the difference of current year quantity and prior year quantity multiplied by prior year profit per unit. This point is important. When it comes to quantities, the profit or selling price that you will use will always be for the reference period, not the current period. So in the case of analysis versus prior year, it will be the prior year profit. In the case of variance analysis versus budget, it will be the budget profit per unit. So you take a difference of the two quantities and multiply it by the profit per unit of either the prior year or budget. So going back to our Excel file, we can calculate the profit per unit very easily from our pivot table. So prior year profit per unit is our prior year gross profit, actual 2021 gross profit divided by units sold. Note again that I'm using the if error function with quotation marks to show blanks where this number doesn't show up with a number. The same way we calculated actual and budget. And here are our quantities. So prior year, actual and budget. This is again just coming directly from the pivot table. As far as the variance calculation is concerned, the calculation for prior year is our actual quantity sold less prior year quantity sold multiplied by prior year profit. Now you see that this formula is a little more complicated, and there is a reason for that, which we will discuss shortly. But really what we are calculating here is the difference of the quantities times the profit for prior year, and same way the difference of the actual and budget quantities multiplied by the budgeted profit for this customer and product type combination. So as you can see, for this first line, our actual units sold were 1,739, which is of course higher than prior year sales of 1684. So we see a positive variance, but it is less than budgeted sales of 1771, and we have a negative variance here. In total, if we add up all of these variances, we see an impact of quantity variance of 75,000 unfavorable versus prior year and 150,000 unfavorable versus budget, and you can see by line item where the differences are coming from. Up until this point, if you are following, we have already calculated the variances in the gross profit. So going back to our hierarchy of variances, we have done the sales margin variances because we have already analyzed sales margin price and sales margin quantity, and we have also calculated the cost variance. So if we add these two, or the way we have calculated, if we add these three, sales margin price, cost, and sales margin quantity, this should reconcile to the total gross profit variance. And we can do this check at a line item level as well in our Excel file. So here next to where we have completed the quantity variance, I have added a check, which is the difference of gross profit for each line should equal the sum of these three variances, right? So we calculate the difference of gross profit in the pivot table by taking gross profit for the year 2022 minus gross profit for the year 2021, which is the difference in gross profit. And from this is subtracted the sum of these three variances, which is price, cost, and quantity. And the difference should be 0. And you copy this formula across and you should see only zeros here, which means your calculation is working. The sum total is also 0 for all of these check calculations, which means this is good. Overall, we can explain now the gross profit variance into price, cost, and quantity. But we know that the quantity variance has further two elements, which are volume and mix variance. And also I need to explain to you why this formula for quantity variance is so complicated. We'll discuss exactly that in the next video. A common complication that arises when analyzing profit variances in this way is that what if there is a new product or customer combination? So for example, the company sold to a completely new customer, or the company sold a completely new product which was not sold in the previous year. In our example, let's take a look at the customer called the backpackers. As you can see, in the year 2021, there is no sales. There's no sales quantity, no net sales or profit. But in the year 2022, there is some sales for backpacks and rolling backpacks to this customer. Now, when we are doing quantity variance analysis, this creates a problem that there is no prior year profit per unit. And because our calculation is based on the actual quantity minus prior year quantity multiplied by the profit per unit, this will result in a 0. And that is why I have added an if calculation in this formula to account for this. What would have the formula been if I had not accounted for this? It would have simply been actual quantity less prior year quantity times the prior year profit. And if I press enter here, you see it shows a 0. And actually this difference also appears in our check, the total gross profit, because we are still missing the $44,700 of profit that we have for this year. And you can see it here in the original pivot table, $44,700 for this product. So in order to resolve this issue, what I have done is I have created a calculation where first we identify whether the combination is new or not, right? So the formula here in the column Q is if and D127, and D127 is the quantity sold for prior year, that is 2021, is equal to 0. So if the quantity is 0, and there are two conditions. One is if the quantity is 0, the actual quantity sold last year is 0, and H127 is not 0. So it means that there is some sales in 2022, right? So last year no sales, this year there is sales. Then in that case, type new, right? So in this column, it will show as new. Otherwise, it will be a blank indicated by the two quotation marks. This is for prior year, but also this could apply for unbudgeted. So the formula is slightly different. In this case, we have again two conditions. If the budgeted quantity is 0, but there is some actual quantity, then it will show us as unbudgeted. Our example, there's no such case where we have unbudgeted quantity. All of the quantities and customer combinations were budgeted, so you don't see anything in this column. But I have left the formula in there in case in your particular example you may need this, right? So we may need to deal with the unbudgeted quantity as well. Going back to dealing with this complication, formula is if Q126 is equal to new, and again Q126 is this column Q, it shows new for that combination. Then in that case, we change the formula a little bit. Instead of taking the profit per unit for last year, in that case, we take the profit per unit for the current year, the current actual profit. If that is not the case, the formula is the same as actual quantity less prior year quantity times the profit per unit for the previous year. The calculation for budget is exactly the same. The only difference is that instead of referring to column Q, where we identify any new combinations, we refer to the column R, which is for any unbudgeted items. And in this case, of course, our difference will be actual minus budget quantity times actual profit if it's an unbudgeted item, and budgeted profit per unit if it's already included in the budget. Okay, so this way we ensure that there are no differences here and we account for all of the variances. So let me just copy this formula back, and you see the difference is now gone. And also what we are saying here is that if you have such a combination where you don't have a quantity sold for prior year or was not budgeted, then it should not reflect in price change or a cost change. It should be reflected under the quantity change. When we get to creating the EBITDA or gross profit bridge, we can show these new or unbudgeted items as part of the mix, or we can also show them separately, indicating whether this is from new product or from unbudgeted product. Before we split the quantity variance into volume and mix, I do want to highlight an important point here, and that is we are currently looking at the variance in gross profit, right? So if you look at the income statement, this is our actual 2022. Our gross profit is 8.3, and the difference with prior year is 649,705. So our gross profit is higher versus prior year and lower versus budget by 621,000. But while we are doing this analysis, we can also explain the variance in net sales itself. So in 2022, our net sales increased by 1.6 million versus prior year, and were behind target by 734,000. As we are doing the calculation for the gross profit, we can also do a quick calculation for net sales, and I'll show you how. So going back to our calculation, at this point, we have calculated three types of variances, which are price, cost, quantity, okay? But we have done this with the gross profit in mind. That's why when we did the quantity variance, we used the profit per unit. Out of these variances, quantity and price also impact the net sales. As far as price variance is concerned, all of the price variance is also impacting net sales. So basically what I'm saying is that this increase in price impact of 1.7 million will also be resulting in an increase in net sales by 1.7 million. However, on the quantity side, unfavorable impact of 75K is on the profit, not net sales, right? So in order to calculate the net sales, we do a small change in the calculation. which is here. So now we are again looking at quantity variance, and we are looking at the net sales impact instead of the profit impact. Okay. So the change in the calculation is that the formula will be entirely the same, except instead of using profit per unit, we are going to use the selling price per unit, which is this column, right? So by this small change, taking selling price instead of profit per unit, you can actually calculate the impact on net sales. So in this column, you have variance versus prior year on net sales, right? So as you can see, the quantity variance impact on profit is 75K, but the quantity variance impact on net sales is 141K. And we can test that if I add the two variances, which are price and quantity. So I know that the price variance impact versus prior year is 1.7 million. We said all of it will pass through to net sales as well. Or in other words, price variance is the same for profit as well as net sales. But if we add to this the quantity variance impact for net sales, which is 141,000 here, you see that the total is 1.6 million. And if I copy this for the budget calculation, you see the total impact is negative 734. This matches exactly the net sales change, right? So 1.6 million and 734K. So with a simple change from profit per unit to price per unit, we have also calculated the impact of quantity variance on net sales. This is important and will play into our calculation later. Now it's time to calculate the volume variance. Here are some important points to remember to help with calculating volume and mix variance. First of all, for volume variance, we look at the change in quantity while keeping the same mix. That is either prior year or budget, not the current year. For mix variance, on the other hand, we look at the change in mix while keeping the same quantity. And in this case, the quantity is that of the current year. For both volume and mix variances, the profit per unit used will be that of the reference period. That is either prior year or budget. We will not use the current year profit per unit, except for the exceptional case where it's either a new product customer combination or an unbudgeted one. And obviously, the sum of both volume and mix variance is the total quantity variance that we have already calculated. So going back to volume variance, the calculation will look like this. We'll take the current year quantity but add prior year mix and subtract from it the prior year quantity and multiply that with prior year profit per unit. For budget, it's again very similar. Just replace the prior year mix with budget mix and prior year quantity with budget quantity, prior year profit with budget profit per unit. So let's take a look at this in our Excel file. I'm working with the calculations that are already done for you. You also have this file available. This is in order to save time, and I'm not doing all the calculations from scratch, but I will be explaining each calculation in detail so that you fully understand how it's calculated. But now we're looking at volume variance, which cannot really be understood without introducing the customer and product mix. So you see here we have three columns, one for prior year mix, the next one is for current year or actual mix, and then the third column is for budget mix. So how do we calculate the mix? The product mix is really based on quantities sold. So for prior year, again, we are linked to the pivot table. And here you see that the actual quantity sold for this product customer combination, fancy retail for the sale of backpacks product, we take the units sold, which is 1684, divided by the total units sold for 2021. So this gives us a percentage that this line, this product and customer combination has as a percent of total quantity. And of course, we copy this formula all the way down. And if you look at the sum of all of these, it should be 100%. So all of your product mix should add up to 100%. The same thing is repeated for actual and budgets. The next thing we do, and this is really important, I want you to focus here, is that, as I mentioned, when calculating the volume variance, we look at the change in quantity, but we keep the same mix as the reference point. When calculating the variance versus prior year, the reference point is prior year. What we are calculating in column AV is actual quantity sold, but at prior year mix. So in a way, we are saying that if the quantity that we sold in 2022 in total was what it is, that is 72,079 units, but the mix, the share of each line was the same as last year. So you can see how I'm calculating this is taking the last year product mix percentage and multiplying it with AS7. Okay. So copy this all the way down, and then in column AW, I simply bring in the prior year quantity. We don't make any change there. We just use the same quantity as was sold for prior year. Before we get to the budget calculation, let's look at then the variance calculation, the volume variance calculation. Volume variance calculation is the difference between actual quantity at prior year mix and the prior year quantity. And then, of course, we multiply this with the profit per unit for prior year. As I highlighted earlier, all the quantity variances, so the total quantity, the volume, and mix, they utilize prior year profit or budget profit, not the actual profit. The only case where they will utilize the actual profit is when it's a new or unbudgeted product customer combination. So this gives us our variance, and you can tell it's a negative variance. This is because at prior year's product mix, our quantity sold would have been lower than the prior year quantity. And this is really an equal allocation of the total drop in volume. So if we look at the number of units sold in prior year was 73,049. This year, the total number of units sold is only 72,000. So there is a drop in units. And when it comes to volume variance, because we are keeping the same mix, this will show that all the variances are negative. Variance versus budget is done in a very similar way, except the only difference is that we now calculate the actual units sold. So again, the same 72,000 and 79 units sold at budget mix instead of prior mix. So you can see the calculation. And then we compare it with the budgeted units sold, and the variance is calculated in a very similar fashion. Actual quantity sold at budget mix less the budgeted quantity times budgeted profit per unit. Okay. So here as well, you see that it is an unfavorable difference. So the sum of all the variances, roughly 101K unfavorable variance versus prior year and 103K versus budget. You could also have done this calculation at an overall level by taking the difference between the total units sold, so prior units versus current year units, and multiply it by the weighted average profit per unit. So the key word here to remember is weighted average profit per unit. For prior year, how is this calculated? We use the sum product formula here. So basically we are taking a sum of last year's product mix and multiplying it by last year's profit per unit. Again, remember, this is the sum product of last year's profit per unit and last year's customer product mix. This gives us a weighted average profit per unit for last year. The same way we have calculated the weighted average profit per unit for the current year and weighted average profit per unit for budget. So if you had to do it at a high level without going into these details, you want to calculate the total volume variance. You can simply take the difference of these two quantities, total quantities sold, and multiply by the prior year weighted average profit per unit. In the same way for budget, you could do the same thing, the difference of actual and budget quantity multiplied by the weighted average profit per unit for budget. And there you go, that's your volume variance impact on the profit. By now you should know that when we are calculating the variance impacting the profit, we use profit per unit in the calculation. And when we are calculating the variance impact on net sales, we use the selling price per unit in the calculation. So to calculate the volume variance impact on net sales, not profit, the calculation is very similar. The only change is from profit per unit to price per unit. So you can see we are using the same quantities as we used for calculating the volume variance for profit, but instead of multiplying with the profit per unit of prior year, I am multiplying with the price per unit. Okay, and the same thing applies for budget. You see we use the price per unit for budget. And this shows us that the volume variance had an unfavorable impact of 199K, almost 200K versus prior year. So you can see the difference here. This drop in volume from 73,000 units to 72,000 units has an impact on the profit, about 101K, and on net sales of about 200K. Okay. And similarly, you have the budget numbers as well. We have now done the first part of quantity variance, which is volume variance. The next one will be mix variance. Now it's time to look at the final variance of our gross profit variance analysis, which is the mix variance. Just looking back at the important point, for mix variance, we said that we look at the change in mix while keeping the same quantity. And in this case, the quantity is the actual quantity for the current year. So the calculation of mix variance will be for variance versus prior year, current quantity at prior year mix minus current year quantity. So you see in this formula, in both cases, we are really looking at current year quantity, but what we are changing is mix, right? So current year quantity sort of reflects our current year mix, but this current year quantity at prior year mix reflects prior year mix, right? So here really what we are looking at is the change in mix, but for the same quantity that is current year. And of course, the profit per unit will be prior year. For budget, it's very similar. Again, we will use the current year quantity in both cases, but the mix will be budget mix, and of course the profit will be budgeted profit per unit. So let's take a look at our Excel file. Now, mix variance, we will look at two ways of calculating the mix variance. One is what I call the bookish way of calculating the variance. It is not very useful. It still gives the same overall result, but it does not help much with the analysis. So first we look at option 1, just so that we are following the calculation and the formula. But then we will look at another way of calculating mix variance, which is more useful, and we'll talk about that. So for the mix variance, as you can see in all three cases, we are really looking at the actual or current year quantity, 72,079 units, but we are comparing with prior year mix and budget mix, right? So the calculation of variance in this case, actual quantity sold this year minus actual quantity sold this year but at prior year mix multiplied by the profit per unit. And the same way we do the calculation for budget. You will notice here that I have added the if function to identify if the product is new or unbudgeted, then it should take the profit per unit for current year instead of prior year or budget. We have already discussed that when we were looking at the total quantity variance. So that total quantity variance exception for new or unbudgeted items, it applies in the mix. And of course, this is when you do not want to show the new or unbudgeted product and customer combination separately in the bridge. If you want to show them separately, you can also identify these variances separately and show them in the bridge. But if you are not showing them separately, you need to use one of the price volume mix variances, then the place to show them that is most appropriate would be the mix variance, because this does reflect in a way a change in mix when you have new product or customer combination. We can perform another check, and the check is really to ensure that the sum of mix and volume is equal to the total quantity variance, right? So if you look at the calculation, total quantity variance, AK7 less volume variance, which is column AZ, and mix variance, which is column BI, should be 0. And the same check is applied for budget numbers as well. I always recommend and encourage putting checks in multiple places so that you can identify any errors in calculation early in the variance analysis and do not have to struggle with unexplained differences later. It's really a good idea. So this was one way of looking at mix variance. Now let's look at the other way, which is more useful, more beneficial of calculating mix variance that makes real sense when analyzing mix. Okay. All right, are you finding this information useful? We still have to go through a lot to understand the other way of calculating mix, which, as I said, is really useful, really helps you understand the impact of the change in mix. You have to go back to the income statement, ask questions about the variances, explain the percentage changes. This is the key. How do you calculate what changed in the margin from 50.6 to 49.6? What drove the change in the profit margin? How to create those calculations. I also have to show you how to create these waterfall charts, how to explain them, which is for net sales and gross profit and EBITDA. And we even have a waterfall, the profit margins, the gross profit margin and the EBITDA margin. And then there's a bunch of visualizations that I have to show you. So don't stop here. Click the link in the description below. You can get all the Excel files that I've showed you so far that are used for these calculations, plus the PDF of the slides. We've only gone through section 1 and 2 so far. We have to go through section 3, 4, 5, 6, and the bonus. So make sure you click on the link in the description and access all of this information that is waiting for you. Good luck.